Hello, everyone, and welcome to Easy Finances. Today, we'll be teaching you how to budget for your first home. Congratulations on taking the exciting first step towards home ownership. But before you start house hunting, it's essential to create a budget to ensure you're financially prepared for this significant investment. Today, we'll walk you through how to budget for buying your first home. Let's get started. A lot goes into budgeting for a home, and it's understandable that you may not know where to start, especially if you're a first-time home buyer. But don't worry. We'll help make sense of the whole process by teaching you the 5 steps you'll need to create a budget for buying a house. Step 1. Review your income and expenses. Calculating your income and expenses will help you determine how much room you have in your budget each month. You'll need to take an honest look at your monthly income and spending habits. Your gross income is the total amount of money you earn before any deductions are taken out, such as taxes, retirement contributions, or health insurance premiums. Your gross income includes wages, salary, bonuses, and any other income streams you may have. Understanding this figure provides the foundation for determining how much house you can afford without overstressing your finances. Once you've identified your gross monthly income, the next step is itemizing and categorizing your monthly expenses. Categorizing your spending by fixed and variable expenses helps pinpoint areas where you may be able to cut back, while also clarifying the portion of your income that can be put towards a down payment and future mortgage payments. For example, groceries are a variable expense, and your spending in that category can sometimes be reduced through more careful meal planning. However, you likely won't want to make a house budget that will require you to cut back too far. Otherwise, you are more likely to give up on doing it. Don't forget to include expenses that occur less frequently, such as car maintenance, family trips, and annual memberships. Work these into your home buying budget by averaging their cost over 12 months. If you find that you're maxed out on your budget, you may need to look for ways to cut your spending. You might consider looking for a cheaper place to live or eliminating eating out while you save for a house. Step 2. Find out how much house you can afford. What you can buy and what you can afford are two different things. You should follow this critical rule. Don't purchase more house than you can afford. First-time buyers tend to shop based on the amount a lender is willing to advance them, not considering other expenses. This can set them up for financial hardship and even a potential foreclosure if they can't afford the monthly payment. When deciding how much house you can afford, one way to do it is by using the 28-36 rule. The 28-36 rule states that no more than 28% of your gross monthly income should cover your housing costs, and no more than 36% should go toward bills like student loans and credit card payments. For example, if your gross monthly income is $10,000, your 28-36 limits would be $2,800 for housing costs and $3,600 for total monthly debt payments. The latter figure is known as your debt-to-income DTI ratio, and it's the ratio most commonly used by mortgage lenders to help determine whether or not you qualify for a home loan. You can divide your total monthly debt payments by your gross monthly income to calculate your debt-to-income ratio. Maintaining a debt-to-income ratio of 36% or less can help you qualify for the best mortgage rates. This also provides you with an additional cushion should your take-home pay decrease or your monthly expenses increase after closing. Mortgage lenders may let you qualify for a conventional loan with a maximum DTI of 43%. However, the underwriting requirements can be a lot more strict, and you'll likely get a higher interest rate. The amount you can borrow will also depend on other factors, such as your credit score. Your credit score is a 3-digit number that quantifies your credit worthiness for lenders. The score takes into account factors such as how much debt you owe and your history of making payments on time. The higher your credit score, the more likely you'll be able to qualify for a lower interest rate on your home loan. Because every mortgage payment includes interest, your interest rate will greatly influence the amount of your monthly payment. A lower interest rate will mean you're paying less in interest each month, so you may be able to afford a more expensive house. Step 3. Plan for your down payment. Another important thing to know when you buy a home is the amount of money you plan to put down. Knowing how much you can afford as a down payment will help you calculate your potential loan principal for any house you're thinking of buying. The exact amount you'll need to put down depends on factors like your lender and the type of loan. This amount can sometimes be as high as 20% of the sale price, but most lenders won't require this much. You may be able to buy a home with as little as 3% down for a conventional loan, 3.5% down for an FHA loan, and 0 down for a VA loan. Your down payment will play a significant role in how much you pay for your house. The larger your down payment, the lower your monthly mortgage payments will be because you'll borrow less money. Plus, borrowers with a down payment of less than 20% will be required to purchase mortgage insurance. Private mortgage insurance, also called PMI, protects your lender if you stop making your mortgage payments. While it may be tempting to use all your available cash for a down payment, it's wise to hold back some money in an emergency fund. If you have a financial emergency and all your cash is tied up in your home, you may be forced to borrow more money to manage. Step 4. Consider your closing costs. Closing costs are fees you'll pay when you close on your home. Closing costs can include lender's fees, attorney's fees, real estate commissions, a title insurance premium, escrow charges, inspection costs, appraisal costs. While these costs are common, some home purchases might come with additional closing costs due to requirements such as pest control and building repairs. Closing costs typically cost 3 to 6% of the home's purchase price. If you're buying a $500,000 home, you can expect to pay between $15,000 and $30,000 in closing costs. If you're concerned about your ability to pay your closing costs, you may be able to get them rolled into your mortgage instead of paying these costs out of pocket. If you roll $15,000 in closing costs into your mortgage, your home will now cost $515,000. This means your monthly mortgage payments will be higher, so you'll need to account for this in your budget. In some cases, you may be able to negotiate closing costs with the seller, but your ability to do so will probably depend on how many other offers the seller has received. Step 5. Factor in homeowner expenses beyond your mortgage. Homeownership comes with additional costs that you may not be used to, especially if you've been renting your whole life. Costs associated with owning a home can include monthly mortgage payments, HOA fees, taxes, insurance costs, utilities repairs, and maintenance. A general rule of thumb is to expect to pay 1 to 2% of the cost of your home on an annual basis for repairs and maintenance. In some years, you may have fewer repairs, and in other years, you may have more. While it can be tempting to buy the most expensive house that can fit into your budget, it's important to avoid spending so much on your home that you become house poor. This term is used to describe people who spend the majority of their income on their mortgage payments, leaving little room in the budget for other purchases that make life more enjoyable. Do your best to live within your means and make decisions that will help set you up for financial success. Now let's recap. Creating a budget for buying your first home involves reviewing your income and expenses, finding out how much house you can afford, planning for your down payment, considering your closing costs, and factoring your home expenses beyond your mortgage. By following these steps, you'll be well prepared to embark on your home buying journey. Thanks for watching and happy house hunting.